Welcome to XTRM Finance, where today we're bringing you a financial face-off like no other. Tips versus I-bonds. Who's going to win the battle of inflation protection? If you're ready to find out how to protect your money from inflation without breaking a sweat, grab your popcorn and get ready for the showdown. Before we jump in, hit that like button and subscribe so you don't miss any of our epic financial battles. Trust me, you'll want to stick around for this one. All right, let's meet our first contender. TIPS, Treasury Inflation-Protected Securities. TIPS are U.S. government bonds designed to combat inflation. But how? Well, they do two key things. One, adjust the principal. The value of the bond increases with inflation, as measured by the Consumer Price Index, CPI. So, when inflation rises, so does your bond's principal. Two, interest payments rise. The interest you earn on TIPS is based on this adjusted principal. So, if inflation goes up, you get bigger interest payments. In short, TIPS are like an automatic inflation fighting machine that's directly tied to the economy's price level. But does that make them the one for you? Now let's introduce contender number 2, I-bonds, another inflation fighter with a unique twist. I-bonds are U.S. savings bonds that combine two interest rates. One, a fixed rate, which is the rate set at the time you purchase the bond and stays the same for the life of the bond. And two, an inflation rate, which adjusts every 6 months based on the CPI. This gives you protection against inflation, just like TIPS. The beauty of I-bonds is that they are easy to purchase, have tax advantages, and can be a great way to start protecting your money from inflation on a smaller scale. But is their power on par with TIPS? So what's the difference between TIPS and I-bonds? Let's break it down for you in the ultimate showdown. Let's talk about purchase limitations. For TIPS, you can buy as much as you want, and they're available through Treasury Direct or brokerage accounts. But for I-bonds, you're limited to $10,000 per person per year if purchased electronically. There's also a $5,000 limit for paper I-bonds if you use your tax refund. Now, on to interest payment frequency. With TIPS, interest is paid semi-annually, meaning you get those inflation-adjusted payments twice a year. On the other hand, for I-bonds, interest is accrued and added to the principal, so you don't get cash payments until you cash them out. This means your interest compounds, but you don't receive it until the bond matures or you redeem it. Finally, let's discuss tax treatment. For TIPS, interest is subject to federal tax but exempt from state and local taxes. Similarly, with I-bonds, interest is also exempt from state and local taxes. However, you can defer federal tax on the interest until you redeem the bond or it matures. That's a nice little tax break. Minimum holding period and penalties. TIPS. There's no minimum holding period, but if you sell early, you may not get your full expected return if interest rates change. I-bonds. You must hold I-bonds for at least 1 year. If you cash them in before 5 years, you lose the last 3 months of interest. So a little penalty if you dip out early. Inflation adjustment method, TIPS. The inflation adjustment happens regularly based on the CPI. Your principal value increases directly with inflation. I-bonds, the inflation rate is adjusted every 6 months, so it's more flexible in terms of when you lock in that adjustment. Now for the real question, which one is better for you? Well, it depends on your situation. TIPS are great for those looking for larger investments with regular interest payments. Investors who want to hedge against inflation for long-term savings will find them beneficial. And people with taxable accounts who are okay with paying annual taxes on their interest might also consider TIPS. I-bonds are great for beginners or those looking to start with smaller amounts. People who want to defer taxes and keep things simple will find them appealing. Anyone who likes the idea of their investment growing without paying taxes for a while should consider I-bonds. It's really a matter of how much you're looking to invest, how long you want to hold, and what kind of tax situation you're in. Let's do a quick recap of the pros and cons to help you make a decision. All right, let's dive into the pros and cons of TIPS. On the plus side, TIPS offer larger investment opportunities. You get semi-annual interest payments, which provide a nice regular cash flow. And of course, they offer straightforward inflation protection with principal adjustments. On the downside, tips are taxed annually at the federal level. Plus, they can be impacted by rising interest rates if you decide to sell early. Now let's move on to I-bonds. The pros include tax deferral benefits, making them great for smaller beginner investors. They also provide excellent inflation protection with flexible inflation adjustments. However, there are some cons. There are purchase limits, and there are no interest payments. Interest is compounded only. Ultimately, it all depends on your specific goals and how much you're looking to invest. Okay, you're probably itching to get started. Let's talk about how you can get your hands on these inflation-busting treasures. Alright, so buying tips is pretty straightforward. You can head over to Treasury Direct or, buy through a brokerage account. There's no limit to how much you can buy. Just keep in mind that the prices of tips change in the market, so you can buy them at par or at a discount depending on the market conditions. Buying I-bonds. Go to Treasury Direct and buy electronically. Remember, you can only buy $10,000 per year per person electronically. If you want to buy more, you can use your tax refund for an additional $5,000 in paper I-bonds. It's super easy to get started, and now you know exactly what to expect from each one. Alright folks, there you have it. The ultimate inflation protection showdown. Tips versus I-bonds. Which one wins? It's up to you. Both of these investments provide amazing protection against inflation, but the best choice depends on your needs. Whether you're looking for tax deferrals, smaller investments, or more flexibility in your portfolio. Now it's your turn. Which one do you think is the right fit for your retirement strategy? Drop a comment below. I'd love to hear your thoughts. And don't forget to hit that share button to spread the knowledge. Let's make sure everyone knows how to beat inflation like a pro. Thanks for watching, folks. If you found this video helpful, make sure to like, subscribe, and share it with your friends who could use a little inflation-fighting knowledge. And don't forget, the battle's not over yet. More exciting content is coming your way. Until next time, this is XTRM Finance signing off. Stay smart, stay informed, and keep climbing those financial ladders. See you next time.